talk to us more about what this earnings season can actually mean for the IT sector. Mantesh is with us right now. Mantesh, thanks so much for making time and speaking with us today. Overall, the profitability has come in better than expectation at 62,000 odd crores, and even in terms of revenue, there is a smidge of a better number coming in versus expectation at close to 62,000 crores. Any first takes on the number?
So the first take that I can see is probably the margin seems to have decreased. I'll have to recompute it because the top line number, like you said, has come in better than expected. But on the bottom line side, the profit is actually declined for sequentially. Now there seems to be a margin compression that's apparent in the results so far. So. And we need to await the company's data in terms of the metrics as well.
So that's a take coming in as far as the first numbers that we have. But overall, what's the view on the IT sector? I mean, is there any hopes that we should pin with respect to, recovery maybe at the second half of the year, or the fact that FY26 can at least be a double-digit growth number? Is that an expectation we should start pinning, or it's too early to call out that?
It seems to be a little too early to call on that. What needs to be watched is how is the deal flow that is happening for these companies. We had seen Accenture some time back actually, reducing their guidance ahead, but the deal flow was fantastically very high, which means that while the companies are able to get outsourcing deals, the way they are getting implemented is getting delayed. So there seems to be a delay in terms of the overall deal pipeline being executed. So execution is the problem. So that could tell me that we should expect better, revenues and better profitability later down the year, and it's too early to call anything right now.
Okay, I think I have the margin figure as well that my team has helpfully calculated, and it's come in at 24.6%. It's a little lower versus the street expectation, I would believe. It's not 24.7 is what we had penciled, so it's not a huge miss. In my judgment, Mantesh, it should go down okay with the street, right? It isn't a bad number on the top line. The revenue is also quite decent in terms of at least the first numbers that we have. And now even on the margin front, it's not a big beat, but at least it's not a howler or a big miss coming in from the company. Fairly in line, one would have to say.
So the margin, when we do the analysis and look at the breakup thereof, the efficiency, that is utilization, is what matters. Most. If the utilization comes in better and despite that the margin is a slight miss, then we would be a little worried. But if it is the margin improvement or the slight fall that you're talking about has come through COGS, which is essentially SGA, which is essentially on the selling side, then probably it could be useful to understand what's the way ahead. So between the utilization rate and the selling expenses that they incur, what is more important is that the utilization rates shouldn't necessarily fall. So showing that the company is doing better on the execution side. If the margin improvement or the small fall in the margin is due to SG&A expenses being controlled, then obviously these expenses will recur once again later down the line.
So that's a take coming in as far as the first set of numbers is concerned from Mahantesh at this point of time. We're getting incremental details and the commentary coming in. The attrition rate has come off and that was expected 12.1%. But K. Krithivasan is saying that they're pleased to report a strong start to the new fiscal year. They're seeing expansion when it comes to certain geographies as well as client relationships. And they're also talking about how the new delivery centers in America, Canada and Europe is expected to play quite well for them going forward. Samir Siksaria is also talking about the fact that despite the wage hike, which is of course going to play a part in Q1 earnings, they have delivered strong margin performance. Operating excellence is something that they have been talking about, and they've delivered on that as well. In fact, on the margin front, it has been nothing short of impressive for TCS of late. Milind also talks about how the increment process has gone in pretty much the fashion that they were expecting. The employee engagement is something that they're working on, and of course, employee retention is something that they've managed to do well, and that's quite visible with the kind of attrition number that we have seen coming in for the company, which is lower to the levels of around 12.1% thereabouts for the company. But Mahantesh, if I had to ask you the top picks within the sector and differentiate it, let's say within a large cap IT and a small cap IT, tell me which are the names that come to mind from the large cap names and then the mid caps.
So from the large cap, it is obviously better to go and stay with the larger peers, the top four. So TCS being one of the larger ones seems to be the one to really go for. But when it comes to mid caps, you have to search out those which are in the engineering services space. It could be such companies as a Tata Tech to Tata Elxsi to even a KPIT. So some of these companies can deliver better growth ahead because engineering services is generally seeing a revival, particularly driven by the driving side technologies that are getting developed. So we should be looking at these companies. But TCS is the largest company among the IT players and the safest, I would consider, for any portfolio. It's like something that everybody would have in their portfolio.
Taken. We are watching out for all of that. Omkar Tanskali also joins us on the show. But before that, just wanted to fill you in with some other details that we've got as well. It's a 4.4% constant currency number coming in. But do remember, this is YOY, not quarter on quarter. Usually, we look at quarter on quarter, and there the expectation was 1.4. There's a net headcount addition that has also happened. So 3 quarters on a row, we had seen that the headcount had declined for the company. This first green shoot emerging now that the headcount has actually improved, telling you perhaps that the company is getting a bit more confident, and it's not a small headcount addition. It's a headcount addition of 5,452 coming in. So that's quite positive as far as headcount is concerned. And even if you look at the other verticals, BFSI continues to be a pressure point because in terms of the composition, BFSI continues to provide lesser contribution overall to the business, and North America too has managed to kind of drop a bit with respect to the contribution that it does to the overall business. This time around, the company has not actually given out the dollar revenue number. At least I'm not able to find that as quickly as usually we are able to, because it's the first number that they usually give. We'll have to look for that further. But Omkar, we have a constant currency number on a year-on-year basis, which is 4.4%. Profit figure of 12,100 crore thereabouts, and then margin figure coming in at 24.6% with a net headcount addition of 5,400 and attrition of 12.1%. First thoughts on the number?
Yes, definitely. I mean, TCS has been demonstrate better execution capabilities, as compared to the large cap peers, and we believe that in this quarter also they have demonstrated better execution. The numbers are largely in line with our expectations. We were expecting some dip in the margins because of the salary hikes, and the management has also highlighted there is to be a bottomed out of subcon cost, though. So we were expecting subcon cost to be going up. I mean, it's been expensive as compared to the previous quarters during this quarter. So largely impacting the operating margin on the negative side. But yes, definitely. I mean, the worst is over now. I mean, slowly, there are some green shoots in terms of demand, and they have started, executing well. There's definitely BFSI and North American side is still under stress, but we will likely, the TCS will, the demand side will likely to continue or improve going ahead.
What kind of deal win number have you penciled in, Omkar? What would probably give you that confidence that the company is on the right path? Because we look at 2 growth metrics usually, that's the deal win and the headcount. We do have the headcount addition number at 5,500 thereabouts. What kind of deal win number and what quality of deal wins will make you confident about the company's growth prospect from here on?
We were expecting around $8 to $10 billion of deal wins during the quarter. As you know, the Accenture have also reported a robust set of deal wins. But I believe rather than it's more of, the headcount growth in the headcount of addition of 5,400 odd numbers is demonstrating well. I mean, it's a better indicator as compared to the deal wins, because in the previous quarter, the deal wins remain resilient, but the execution was delayed, and the decision making also delayed. Due to that, there were IT sectors overall showed the laggard growth or the tepid growth in the previous quarters as well. But I believe, yes, definitely the headcount addition is definitely a green shoot, and we are likely to be demonstrating a further ramp up of the deals that they have won in the previous quarters as well.
If you like this video, then like, share and subscribe to ET Now.